Doordash stock is up 32% year to date. In this video, I'll do an in-depth analysis of the company by looking at the fundamentals and running a discounted cash flow model to calculate the intrinsic value of the company and potential future returns. Very quickly, if you are not from the US, Doordash is a platform that connects customers with local restaurants, grocery stores, and other retailers for fast, same-day delivery or pickup. Doordash has seen very good revenue growth in the past decade, growing from $291 million to $12 billion currently. And analysts are still expecting very good revenue growth as they have Doordash reaching $14 billion this year and grow to $25 billion in 2028. This is a company that turned profitable this year, and they are currently generating $863 million in net income. However, a positive is that they've been free cash flow positive for much longer, and they are currently generating $2.2 billion. This is why analysts have them growing EPS, which is calculated through net income, by almost 700% growth this year, and grow to $2.29 per share, and then growing to $10.51 per share by 2028. Another reason for this massive growth in profit is their high margins, with gross margin being at around 50% and free cash flow margin around 18%. One negative aspect about their financials, however, is the share dilution. They have been increasing the number of shares outstanding a lot in recent years. This is horrible for investors as you own less of the company and are sharing the profits with more people. Then, in order to calculate the intrinsic value of the company and potential future returns, I use my Google Sheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $96 per share, middle $184, and high $327. And because the stock is currently trading at $225, this means that if my low assumptions occur, you're going to get a negative 3.9% annual return on your money, middle positive 6.6%, and high 16.7%. So it would only be a buy according to my high assumptions. Now, as far as them, I assume Doordash grows revenue 10% annually in my low assumptions, 15% in the middle, and 20% on the high. They average a profit margin and free cash flow margin between 15 and 25%, and I assign the PE and price to free cash flow at the end of the 7 years of 16, 18, and 20. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumption. Moreover, Doordash is currently trading at a P of 117 and price to free cash flow of 42, and we can conclude that the company is trading a bit expensive. However, they have an amazing balance sheet with $4 billion in cash and $3.2 in debt, which is nothing for a company that has a market cap of $96 billion. And in conclusion, although I believe Doordash could end up being a fantastic company, the current valuation, share dilution, and the Uber Eats competition make it too risky right now in my opinion for investment. Lastly, if you want a discount on stockanalysis.com, the best place for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Doordash stock in the comments, and I'll see you in the next one.